Howdy, Jacob here. Today we're looking at DXC Technology in the IT services industry. 3.8 billion market cap with a lot of debt here, 6.1 billion enterprise value. Growth looks good over a 10-year period, but is actually down fairly consistently from 2018 to today, averaging like minus 0.6% year over year growth. I do wonder what exactly that is. We're going to look at the cash flow statement a little bit to see if there was any devastations or anything. And then we'll also look at the balance sheet, see if we find anything. But they did remove their dividend in 2020. Their gross margin is a little bit down, about 22%. That's pretty low. Operating margin, up and down, but averaging mid-single digits, I would say, with a not so fantastic and consistent return on invested capital. Let's look at that income statement first. So no R&D spend, just a heavy amount of cost of goods sold. Balance sheet shows a huge decline in goodwill. I wonder if they sold off a business or whether they purchased a business in 2018 and it ended up fluffing, not doing anything for them. There's a definite possibility that that was the case. From a liquidity standpoint, they have 1.2 billion cash on hand with 93 million short-term debt, 3.6 billion in long-term debt. So 3.6 billion long-term debt is less than 3 years, or is roughly 3 years of their free cash flow of the last 3 years. The thing that I do appreciate is that their free cash flow is much more consistent than their earnings, and it appears to be due to a heavy amount of depreciation and amortization, well in excess of their capital expenditures. Their use of cash has been very heavy on paying down debt, very heavy on share repurchases, and then a little bit on the reinvestment and acquisition side. So we're probably looking at roughly 20% to acquisition and reinvestment, and then split about 40-40 share repurchases, debt paydown. For capital allocation, let's get right to it. Let's make some assumptions here. For revenue growth, I mean, they're in a declining state right now. I think that I'll probably put in the possibility of them growing again. I mean, they're definitely in an industry that seems to be pretty promising. So it could just be some bad things going on right now, but I will be projecting 3%. Nothing impressive on the price to earnings side because their enterprise value is quite a bit above market cap. I think I'll probably settle for a 12 PE. For margins here, I love that free cash flow is higher, as I said. Hey, let's do 6 and 8%. And wow, interesting. Okay. Share change of 1% for them, 600 million, 500 million if you offset stock-based compensation. That is huge amount of share repurchases available. So they're focusing on debt pay down, 600 mil a year. I mean, they could pay that off in 6 years. Debt's not a huge problem. I think the biggest problem people have is with this growth. So maybe I guess I'm getting swayed here just a little bit. But if I do 0, 8% with share repurchases, 1% is 38 million. 38, 380 million, 480 million for stock-based compensation, which is about 40% of free cash flow. So, okay. Right now it's saying it's a buy given my current assumptions, which is very interesting. These businesses are always tough because you can find them at cheap prices, but this is when you really have to do a deeper dive to see whether your assumptions will be able to hold or not. And the biggest thing is, can they keep this 8% margin up with declining revenues? Or is the company going to have to reinvest a whole bunch of money to probably not even hit the top line and definitely lose a lot on the bottom line? So right now it's saying it's a buy or pretty much a buy with, pretty conservative assumptions to me. So this is going to be something I'm going to have to do a deeper dive on soon, and I'll hopefully publish it. If I'm being honest, probably in the next month or so. I've not been doing a great job of doing some in-depth videos, but I mean, this looks interesting. Look at the amount of share purchases they have with 40% capital allocation. I mean, I know they have a lot of debt in relation to their market cap, but in relation to their free cash flow, I mean, that's not very substantial. 3 years of your free cash flow in long term debt, that's not that horrendous. But they are a declining revenue business consistently. So maybe I am being a bit generous over here. So yeah, this will be something I just look further into shortly. Hope you enjoy the video.